Every trader on YouTube is chasing the same fantasy, a no-loss option strategy that turns a tiny account into easy money. Infinite profit with zero risk. Sounds great. Those videos are loud for a reason. Because the promise collapses the moment the adult in the room pulls out real math. Here's what nobody tells you. Zero-risk trades do exist. They just look very different from what some trading gurus want you to believe. They're quiet arithmetic trades. And today, we'll show you how they work using riskless collars, box spreads, and riskless butterflies. And these are all strategies you can use to screen the market with Option Samurai, as we will show you in a few minutes. Before we start, let's set expectations clearly. This video is not about magical, no-loss strategies you see online. Most of those are fake, incomplete, or simply misunderstand what risk actually means, and you will only end up losing money following those approaches. We're going to define what a real zero-risk option structure looks like. One where no possible market outcome produces a loss. These setups only become riskless when pricing aligns, and when that happens, the return is anchored to the market's risk-free rate. You're not predicting direction. You're exploiting pricing gaps to earn an amount of money that's close to what a bond would give you, sometimes slightly lower, sometimes slightly higher. So what does zero risk really mean? Here's how we'll break it down for you. We will begin our video with the myths. Let's start with why most of the no-loss strategies that you see online aren't real. The first myth is the directional fantasy. People want a magical setup where they risk a little, make a lot, and somehow avoid losses entirely. That doesn't exist. Directional trades always carry directional risk, although sometimes that risk is just to have a smaller profit than a bond, but we'll get back to it in a few minutes. The second myth is the idea that one trade can magically make the next one risk-free. You'll hear things like, if you open a trade and make $100, then the next trade is risk-free if your maximum loss is less than $100. But that's not zero risk. Think about it. If trade A had lost you money, trade B wouldn't even exist. And trade B still has downside, no matter where the money came from. Using old profits as a shield doesn't remove risk, it just hides it. We cannot stress this enough. Real zero risk is structural, mathematical, and independent of past outcomes. To understand where real zero risk opportunities come from, we need to zoom out for a second. In theory, traders can encounter three different kinds of no-loss windows. The first is a pure price mismatch between options, when the options pricing models may break. They exist, but they last seconds, or even less, and they're gone the moment market makers correct the imbalance. The second are deep in-the-money structures that behave like box spreads. They can lock in a payoff, but they come with assignment risk and operational headaches. The third is the easiest opportunity to find, the one relying on the risk-free rate built within the put-call parity principle. These are the most practical, the most stable, and the most repeatable for retail traders. Put-call parity forces calls, puts, and stock to agree on one fair value. But within the put-call parity idea, we can find the risk-free rate in the market. That gap becomes a locked-in, zero downside profit, and it will always be tied to what you can earn with a bond. Okay, so you now know where this price comes from, but do you actually need to be a mathematician to find these opportunities? Absolutely not. Here is a simple way to do that. You don't need a PhD to spot a parity gap. You just compare a real position to its synthetic twin. If they should be the same, but they aren't, congratulations, you found a pricing gap. Let's do this with an example. First, let's look at a standard trade. Suppose you open a long $155 call. And let's say your maximum loss is $5,100. Now take a look at the synthetic version of that same call. You buy 100 underlying shares, and you also go long on the $155 put. You have the same expiration, the same strike, and the same payoff shape as the previous long call. So the downside should be identical, right? But here's the thing, the payoff isn't identical. In the first case, you could lose $5,100. While in the second one, you'd lose no more than $4,400. And that difference gives you a risk-free trade window. That gap tells you the standard call is overpriced relative to its synthetic version. You have the same payoff, but at a different price. So here's the trade. You short the expensive setup and buy the cheaper one. Put it all together, and the net capital deployed is $15,366 with a guaranteed $700 profit. No matter where the stock finishes, the difference between the two payoffs guarantees the same result. Up, down, sideways, everything cancels out. That $700 represents an annualized return close to 4%. That's not a coincidence. It's roughly where the risk-free rate in the market sits. This is why we say that real no-loss option strategies tend to mirror the risk-free rate. Now that you know where the edge comes from, let's look at the actual structures that use it, and you will soon realize that you may even earn more than that risk-free rate from our previous simple example. Let's start with the most familiar structure, the collar. In its normal form, a collar is simple. You own shares, you buy a lower put, and you sell a higher call. It reduces risk on your share position, but it's not a zero-risk trade. A zero-risk collar uses the exact same structure. The difference is pricing, using the same put-call parity principle we shared earlier. In fact, you'll find that the whole payoff can be positive. Now, every possible outcome sits above zero. At this point, your risk isn't losing money, but it's still there. Why? Because your risk is earning less than the risk-free rate in the worst-case scenario. So why would you do this instead of just buying a bond? Because if things move in the right direction, you can actually earn more than the risk-free rate. That's the trade-off. You give up certainty at the margin to gain conditional upside, without ever opening the door to losses. One last thing. This risk-free collar does not have to follow a bullish structure. You can build the same setup, but in a bearish way. If you buy 100 shares, sell a lower call, and buy a higher put, the logic stays exactly the same. Now you earn more money than you would with a bond if the stock goes down, but you still make money if it goes up. You have the same structure and the same parity logic, just a different market view. Let's move on to the next no-loss strategy in our list. A box spread is the cleanest no-loss structure you can build using only options. You do not own shares and have no directional risk at all. Start with a bull call spread. Now, stack a bear put spread on top of it. Use the same strikes and the same expiration. What you get is a payoff that never changes, no matter where the stock finishes. The catch is that the return will often be tiny. That's why box spreads are mostly used when you trade a large size position or when funding conditions make them attractive. You should know that there's also a short version of this strategy, but that may come with a high assignment risk. This is something you should keep in mind before opening a short box spread. The last strategy we'll show you before telling you how to find risk-free trades on Option Samurai is very peculiar, the butterfly strategy. You may know the butterfly as a strategy designed to make money around one specific price. For instance, this is the payoff of an at-the-money butterfly. Outside that middle zone, there's usually risk. In another video you can find on our channel, we tell you why we prefer to trade out-of-the-money butterflies, so feel free to watch it after this video is over. But for now, let's stick to our zero-loss trade opportunity. Take a standard iron butterfly. Now, here's the idea. You can turn this into a no-loss structure. To do this, you get rid of the short put, and you add shares. For our example, let's push the butterfly out of the money. What you end up with is a very different butterfly. Both wings are already profitable, no matter what. And the middle, that's just bonus territory. Like we said in our butterfly video, you'll likely end up closing this trade early without really aiming to reach that unlikely point at the top of your triangle. Just make sure you take into account the assignment risk here. So when does zero loss actually make sense? And how to find these trades on Option Samurai? First, let's be clear about the trade-off. Zero loss generally means small, steady returns. These are returns that compete with short-term bonds, not magic wands. Some structures, like the zero-risk collar or the risk-free butterfly, can earn a bit more, but only conditionally. If you want a zero-risk trade that may give you more than the current risk-free return on the market, then you have to accept the possibility of earning less than a bond would yield. This is exactly where tools like Option Samurai come in, helping you spot when a zero-loss collar, just to name one of the strategies we saw earlier, actually exists. For instance, you can create your own scan by clicking Compose New Scan. Click Custom, then add a stock leg, a long put leg, and a short call leg to create a caller. Make sure you only see the profitable trades by setting the return to be above 0%. Next, click Add Filters and add the break-even percent data point. And finally, sort your results by ascending break-even percent. Click Run Scan and let your output load. And you will now be able to check out a list of risk-free collar setups for you. If you want higher returns, you have to accept some controlled risk. And like in a no-loss collar, your risk will always be an opportunity cost. You may earn less than what a bond would give you. Zero loss isn't about getting rich fast. It's about knowing exactly what you're trading off and choosing it on purpose. If there's a strategy you want us to unpack next, simple, complex, or somewhere in between, drop it in the comments. We read them all, and the best ideas turn into the next video. Option Samurai scans millions of option combinations in seconds, so you can focus on the ones that actually matter. Start your 14-day free trial. Find your edge with Option Samurai. And if you want to keep learning, click here for the next video.